What's up, guys? I'm Nobody Special, and gold hit another all-time high today. And as it happens, I'm lucky enough to have Bob Coleman, the CEO of Idaho Armored Vaults, is with me here today, and we're going to talk about gold and, of course, my favorite of the shiny silver. Bob, how you doing today, brother?
Good, good. I tell you, the only thing thinner than the markets right now is my hairline.
Yeah, you and me both. I got the boat slips going, and my hairline's not receding. My forehead's just growing. That's what I like to say. So the market is thinner. That's an interesting way to start things. So you're kind of seeing the same thing I'm seeing then, the lack of enthusiasm for metals at all-time highs here.
Yeah, the market, you see it typically August, especially the last 2 weeks of August, get really thin. People are on vacation. You have pretty much a whole month of August. You have refineries that are out in Europe. Just a lot of people on vacation across the world for the most part. And that thinness in the market tends to create these price spikes because you just have a lot less volume. It's easier to push the markets around. And I think that's why you see the paper price is doing well on gold and silver, but in terms of physical retail demand, you're not seeing a lot of activity. I mean, there's some decent spouts here and there from day to day, but you are seeing people still selling back into the market. So you're seeing dealers with very light bids. I mean, I've seen some of these like $2 under spot for 100-ounce silver bars from these major online retailers. So prices are still um, uh, inventory levels, I should say, are still fairly high amongst the retail dealer industry.
So $2 an ounce under spot you're seeing
Yeah,
when you go to sell your metal back to the dealers right now. So that it's pretty big. We'll use the word bifurcation then between the paper market and the physical market, right? So premiums, the dealers aren't paying up. That means they're swimming in a lot of inventory. Does that also mean that the dealer premiums for the buyers, if you're out in the market looking to buy physical right now, are there deals to be had, or are the premiums still pretty high in the physical space?
the premiums have been coming down really throughout the year, depending on which dealer you're buying from, whether it's online or local. Some of these guys may have still very high premiums relative to, like for example, for 100-ounce bars, anywhere from $1.20 to $1.50 over spot, something like that would be the norm, or at least that's what we kind of have it at. But you may see it $2, 2.50 over spot, whereas maybe a year and a half ago it would have been $5 over spot. It's just that the problem is a lot of people that bought metal 2, 3 years ago paid $5 over spot. Now they're going to sell. Say they bought silver at 20, they paid $5 over spot. It's at 30. Now they want to sell it. Now they're getting $2 or $1.50 under spot. They're barely making any money. I mean, the spread is just killing them. And I think that's one of those. It's like a voodoo doll almost. It's another pin being stuck, and it's deflating sort of consumer demand for the product because they're just not making any money at it. It's very difficult to, and so that's it's one of the difficult things when an industry sort of gets swamped with demand all of a sudden and doesn't have any structure or regulatory oversight in terms of trying to keep these premiums kept.
That's one of the reasons why I like to bring you on to talk about metals, Bob, because you're light on the hyperbole, if you will. You're light on the doomer rhetoric, even though I embrace the doom as much as the next guy, arguably more so. But you tend to have a very grounded approach. And I remember during the silver squeeze, you were pretty outspoken saying, hey, guys, we're overdoing this, referring to the other industry participants. We're bidding up these premiums here. We're selling this story that's not really grounded in reality, and we're doing it to drive up our own profit margins. We're going to burn our customer base, and in the long run, it's going to hurt the industry. And I know you caught a lot of flack for that, but here we are. The people who bought that metal, they're in hard times because the cost of inflation has driven up their cost of living. So some of these people are being forced to sell this metal back to the dealers now, and maybe they paid almost $10 an ounce above spot if they bought on some of those peak panic moments. Now they're getting $10 under spot when they go to sell it in. That's a $12 an ounce delta. It doesn't matter what the price of the underlying metal does. If you're eating that kind of a swing just on the premiums, it's going to be really hard to turn a profit in that environment.
It is, and at the same time, you also have people that had bought back in the the great financial crisis 2008 to 2012-13 era that have just been waiting and waiting and waiting, especially on silver, to have it come back to a level where they could make something off of it, or say, hey, listen, I could at least break even. And it's been difficult. I think even for a lot, I mean, gold's done tremendously well, and I think it's just this. I think we're all watching silver to say, okay, when is that day in the sun going to come? And I think that's you're seeing the setup that's developing here. Oddly enough, though, for that setup to develop, you have to have a lot of sort of rancor and discontent, I guess, flow into the markets where people just say, I'm done. I don't want to hear the word silver again. And that's like usually the lightning rod for this thing to start taking off.
And well, I mean, that's kind of where we're at right now, right? We opened the show talking about how there's like, where is the enthusiasm? It's non-existent, even though gold is at an all-time high. I know silver is lagging, but you'd think with gold over 25 an ounce for spot, you'd have that enthusiasm. It's just not there in the market. Now we had go ahead.
Yeah, I think it's this world of immediate gratification that everyone kind of looks at, and if silver isn't making that immediate move with gold, they're like, okay, this thing's just another metal that's going to be caught up in the industrial side, not necessarily the monetary side. And so, is this thing going to go the way of copper and get creamed, or is it going to, is it going to be able to fight its way through? And that's part of the allure, because what happens is then you have people that are, the money management side, like manage money and so forth, start to reduce their position size. They start to build short positions, and they start to say, hey, listen, okay, silver is industrial oriented. And if the economy is slowing down, playbook says, okay, we short commodities because there's going to be less demand, and uh, uh, we'll play the price action to the downside. But the problem is, if that short position doesn't, or that price action doesn't ferment to the downside, now you got fuel that's going to be buyers that come back into the market to close that position out. And that's typically when you see the short squeeze develop.
So let's talk about market positioning. That's a good segue. I'm going to share my screen here. This is a chart that you had me bring up. This is barchart.com, and it's showing the positioning over time according to the Commitment of Traders report. You got several lines on this graph here. The blue line, that's your other, right? Your small
managed money. The gold money.
Okay.
Yeah, yellow or gold is the other.
Okay. And then your green and red, that's in red, that is your commercials. I guess your miners, right? They're always short the metal there. So they're to manage their exposure. The miners are always short. And then green, that's your large commercials, like your banks, your bullion banks. So you had a pretty good call back in February. You mentioned that the blue line here, the managed money, that was pretty low. The other reportables in the managed money, that was way down. And you said in February that, hey, we were set up for a nice squeeze in silver. You nailed that call because silver rallied like the blazes for the next few months. And now you can see everybody kind of piled back in. The long positioning, right? As you see this chart moving higher, that's the managed money getting more long silver. And then metal kind of took a break through July, June, most of August so far. Now we've noticed it's taken a little bit of a step down. We had a little bit of a flushing out of those long positions recently. What played out there in the market, and what is that telling us about where we might be going from here?
Yeah, some of that could have been also due to the August sell-off. You have to look at the sell-off and what caused it. Part of it was the CME raised margin requirements literally the day after the top in the S&P 500, and they raised margin requirements on almost all stock indices in mid-July, and then they raised margin requirements 2 weeks later, the week before that, or the week of the sell-off, going into that big sell-off into early August. So it was really those margin hikes that actually started to squeeze stock indice positioning. And that kind of rolled over into commodities markets and foreign currency markets. Basically, when you start to get a big draw in the market, drawdown, everybody gets impacted initially, because you got to remember, gold futures trade on margin just as much as stock index futures, and anybody who gets caught, they'll have stops under the market. They're playing with leverage at that point, so they're forced to sell, and that's what sort of caused this repositioning. especially in the silver market, you saw a lot of managed money come out of the market during that big sell-off. They were just, either forced out of it, or they were building short positions to try and take advantage of the downside move.
And I didn't mention that when I showed this chart. This is the commitment of traders for silver. I'm sorry I didn't bring that up. But yeah, big move down mid-July there. I guess that was the margin requirements. Now, you also mentioned that sell-off in August. I've got that chart keyed up right here. This is the price of gold now, and we're looking at hourly candles. And what we're looking at right here was this big sell-off that I want to draw your attention to. This was Friday, August 2nd, and then into that panic on Monday, August 5th. So this is that whole big Japan carry trade unwinding panic. And you'll notice gold did not do very well during that event. Not at all. Gold sold off pretty hard. Now, gold is a safe haven asset. You'd think gold would do well during a freak out about a recession. We had a bad jobs report on that Friday. I think that kind of started this sell-off, and then the Japanese got involved as well, and the currency trades unwinding. Is that pretty common to see gold perform so poorly during a volatility event like that? And what does that tell us about what might be in the horizon or coming up in the future here?
Yeah, you kind of have to put it in perspective a little bit and add some context. Positioning in gold and silver got to very high levels in the managed money crowd, for example, leading into the summer. And so, unlike the sell-off that we had, like we had some previous sell-offs in the market, and you didn't have as much bigger as big of a positioning of in the managed money side, and so the metals didn't get creamed. In fact, actually, a couple of those times, actually the metals markets actually were one of the few that were actually up on the day. But you just simply had a lot of positioning to one side of the boat, and the boat just shifted. I think that's what you kind of saw there, and that's the problem when you have the paper leverage markets intermixed with, and the underlying physical market, is sometimes those markets will have a bigger impact or be affected more so on a big broader sell-off like you had with this unwind of the carry trade and that type of thing. So it was just really more of a reaction to positioning, I think, going into that sort of chaos. For example, now if positioning doesn't rebuild itself, but the market starts to find its footing here, like on gold hitting new highs, and if the positioning doesn't start coming back into the market, that would be kind of interesting, because at that point, you're not seeing more and more people jumping back into the market and making it more vulnerable, I guess. But that'll take a couple of weeks to kind of to filter that out.
Yeah, so I mean, we had a pretty ferocious sell off that morning. Gold reached a low of around 2360. And, I guess when the margin man calls, you sell whatever you can, not what you want to, right? And so the margin calls came in. There was some forced selling. We traded sideways for a day or two. And then, of course, ever since then, gold is just up and to the right, now making new all-time highs. So certainly quite a recovery in the gold market here. Now, you also had some pretty interesting things that you had put out on Twitter. In particular, this one, you just put this out today, and you gave me a shout out on X. Thank you for that. You're saying many have been asking what is driving the options activity and large amount of share creation for the SLV ETF over the summer. We've seen a lot of new shares. I know SLV, there's a lot of sensitivity around that subject, a lot of, well, let's just say it's not too popular with the physical crowd. We'll put it that way. Precious metals structured investments to institutional investors are back. You discussed this in 2022. And now you're making reference to this recent offering from JP Morgan. Now, let me just go and throw out what you threw out, the disclaimer. This is not in any way promoting this investment product. We're just talking about this thing. What on God's green earth is the dual direction trigger plus based on the performance of the iShares SLV trust? You sent me this thing and my head started spinning when I tried to figure out what is this thing JP Morgan is selling.
Well, the only reason I put the disclaimer on there is because I also am a registered investment advisor. So I didn't want the SEC think I was actually promoting this product in any way. So it's one of those just sidebar things. But yeah, this is typically, these structured products if you go back to anyone who's seen the movie The Big Short, well, Michael Berry goes into Goldman Sachs's office and says, "I need you to write me up a contract so I can short the real estate market or mortgage market." Basically, that's what this is. This is a very structured investment product that's maybe for an institution or a accredited investor or a group of investors, or even a structured product that's going to be sold out into the institutional world. And this just happens to be, institutions and accredited investors have these, oddities where they want to participate in an asset class, but they may not want to own the underlying itself, or their charter just doesn't allow them to own, actual physical metal, but they can only own a security. So they go to Wall Street and say, okay, I need exposure to this. Can you write me up something, a security that I can, have my charter will allow me to invest in. So that basically, it's a Wall Street can be very creative, as you know. So they have buffered notes where they have downside protection. They have, leveraged upside. This would be something that actually dual directional triggers, basically where you have some over performance points that can occur if the market goes up or down within a certain range. And in this case, if it drops, I think the first 15 or 20%, there's actually a little bit of a kicker where you actually outperform because you're getting some directional bet to the downside. And if it goes up the first 20%, you may get a little bit extra kicker to the upside. And so what happens is these institutions will go in, or sorry, the market makers, wherever is creating this product, they'll go in, deliver silver to SLV, create those shares, grab those shares from an indexing standpoint or a structured product standpoint. They have to have the underlying maybe in this structured product, and then they go out and they'll use options as this leveraged effect for performance or for downside protection. They'll use options, whether they're writing or selling or buying those options. That's where that comes into play. So you watch the option activity, and sometimes a lot of the big volume that starts to develop in the options world is really from these market makers creating these products that are going into the market at some point and writing calls. They have a big size position that they need to fill over a course of a few days to get in order to get this structured product correctly calculated or in this case structured.
So I was reading about this product, and it's pretty unusual. And this is not an exchange traded product, guys. So don't go looking for a ticker or anything. This is this obscure product they created for other big money. But you're levered to the upside. If silver goes up to 20%, it's a big levered payoff. If it goes down up to 20%, you actually still make money if it goes down less than 20%. But then if it goes down more than 20%, you start to lose money. It's a very obscure product here. Now, if you're JP Morgan and you're selling this big levered upside product. So you're actually massively short silver if you're JP Morgan and you're selling this thing. So correct me if I'm wrong, Bob, in order to maintain neutral positioning, if I'm JP Morgan, I'm going to go out and buy a bunch of silver, or maybe have a bunch of shares of SLV created to back up this product so that my net positioning stays at zero and I'm just collecting my fees. I don't lose money either way. Is that
right?
So does that explain why these additional shares of SLV were created and why there's so much options activity around SLV right now? Something like this?
Yeah, this has an impact and influence in that. I mean, it may not, that 50 million shares or 50 million ounces created or added to the fund over the last couple months may have also been institutional ownership, retail investor ownership, piling into the precious metals, especially as the miners started to take off and the market started to broaden. But you also have, and this isn't anything new. This is old school Wall Street. This is that they have structured products on pretty much anything. I mean, they have structured products. If you want to, for example, say, listen, I want to bet between Amazon and Home Depot, and I want the lesser performing of the two and I want some type of return off the lesser performer, or whatever it may be. They'll create it. They'll create anything you want. It's just all it is math. And so, um, again, you're right. They're just collecting a fee off this. They just got to put it together. An individual or a high net worth investor could probably create the same scenario for themselves, but they just got to do the math and know how many options to write and to buy, and what time frames and spreads that they got to go through to make that happen. Here, Wall Street just does it for them and charges them a fee.
And it's ultimately just a fee shop, right? That's what they are. So they maintain their neutral positioning. And it's also a cautionary tale, right? You see suddenly a big, large creation of new shares of SOV. It looks like people are piling back into the market, but really what you're just looking at is the hedging from this big JP Morgan, who's hedging this financial Frankenstein that they've created that's indexed to silver. So the data can be misleading. It's important to keep that in mind. Now, another story I wanted to talk to you about is something I just caught wind of recently. This Oxford Gold Group. I got this one in ABC News here. Gold investments with Beverly Hills Company ends with loss of thousands of dollars, customers say. And I hate to see people losing their retirements, but it looks like that's what happened here. What's going on with Oxford Gold Group? And what are some of the warning signs maybe that people could have looked for that would have alerted them, hey, something's up here?
Yeah, I saw the I guess the interviews that they did and sort of the piece, and they did a good job of trying to alert people out there. This is what you tend to see. Like, for example, the guy says, I got this glossy image of what I bought, and it was just like, this nice little portfolio they put together for me. And yet when he calls the depository to check on if his metals are there, in this case it was a big name depository. He doesn't actually have the storage account with this depository. The storage account is actually with an IRA custodian, so he's basically a sub account of a master agreement. And so typically a depository doesn't have any contact with the sub account holder. They just have an agreement with the master account holder. So he calls them up, they don't know who he is, and then all of a sudden alarm bells go off, saying, "Oh my God, what happened to my money?" He contacts the IRA custodian. They don't know what happened to it. They've been waiting for the metal to come into the depository, and it's just one of those things where a gold dealer doesn't make actual delivery. And it's one of the things I've been warning people about really for the last 2, 3, 4 years was watch out for companies that will use sort of glamorous locations as their office, or give you deals that are too good to be true. Or you see the other side where they offer these limited offerings of 1.25 ounce silver coins, or 2.5 ounce silver coins that are made by the Royal Canadian Mint at limited production, but they're sold as some sort of collectible, and that they have a massive premium attached to it. You see it with 0.25 ounce gold coins and things like that. It's just a way to charge a higher fee. And then the question is, some of these outfits never make delivery. They take 6 months to fulfill an order. They have a slew of people that have never received it, and then all of a sudden, I've seen some of these things on YouTube where the insider from one of these companies actually talked about the process, how ultimately when someone made a complaint and literally was going to make it public online, they would then pay him off with maybe someone else's money that they were waiting for product with, but made him sign a non-disclosure agreement. So all of a sudden the client got his money but couldn't say anything. That's actually from an insider on one of these older gold dealers that have now gone bankrupt, I think it is. So there's a lot of games that are played in the industry, and I fault part of it is there's no regulation. It is literally the Wild West. You really got to be careful, even with big online dealers and how much they charge over spot, like we saw the last 4 years. There's no oversight, no accountability, no transparency. There's, of course, especially now, people are starting to realize, hey, listen, I paid $5 over spot for this one product. I go to sell it back, and now I'm getting $1.50, $2 under spot. I was never told that. I was always thought that I would get something back, maybe above spot, so my spread risk wasn't as great as it actually turned out to be. Those are all risks that aren't discussed, and they should be with the customer before they buy.
Yeah, with this outfit in particular, I mean, this never even rose to the point of fees or excess commissions or anything like that. They just took the guy's money and never bought any metal. So I
Yeah.
mean, they just this was just an outright theft. Um, and there are these companies, they pop up left and right. I get emails from these companies all the time. This one is a pretty egregious example here, and this money's gone. This guy's never going to get his money back, and they prey on people. They tend to lean on people's religion or even politics to try to find common ground and develop trust and rapport with people. They send the glossy, expensive card stock investment packet, or it might even be this nice bound. It might even look like a nice book that they'll send to your house, spending all this money on the information with the catalog that you can pick your gold from. But it ends up just being a scam. And there's so many of these out there. It really is a minefield. So you got to be careful, people. Do your research. And even when you do your research, you almost have to research your research, because I looked into Oxford Gold, and there are YouTube videos pumping these guys. They look like they're like AI generated, like fake videos saying, oh, they're a number one best investment, 10 years running, all this stuff about them. It's pretty scary, to be honest with you. So, I mean, what else would you say? How might somebody guard against something like this if they're not sure if this company is legit? How
Well,
how would you check?
yeah, and well, there are companies that used endorsements like Fox News contributors and actors, and those actors and those people never even gave them the authorization to use themselves as endorsements. I mean, it's that Wild West. But it's and then you have the industry where you actually have marketing firms that will put out a review or a recommendation of this is the gold dealer of the year report, so to speak. And you see some of these companies that were now bankrupt, that were listed as fastest growing Fortune 5,000 company, or so whatever it may be, but they were listed as some growth oriented great company, but turned out that they were basically milking investors, and that revenue became their profit, so to speak, and then they run off to the sun. But you got to be worried about the marketing companies that promote these, that write up these reports as gold dealers, that they're really just fluff pieces. They're just advertisements, that are paid a lot of times. And so it makes the gold dealer look like that's, hey, we've had this independent review by, it's not like a independent CPA accounting firm, that it goes in and looks at financials and does a full financial audit and says, oh, yeah, this company is really legit. You don't even see that. That's why some of these online digital token companies that sell metals and things like that, you've never seen um, a full financial audit from some of these that proclaim to have audits and stuff like that done. Yeah, and so you really got to be, you got to have sort of, don't be as trusting, especially when you watch someone on YouTube and say, well, God, I really like what the guy's saying. It's just, there's a lot of bias confirmation that starts to be sort of built on, and he's saying all the right things. He's politically same view as me, and all. A lot of this is just salesmanship. You just try to talk to, if you can, departments of finances for various states that you're in, to see if there's any complaints against these companies. It's very hard to find that kind of stuff just online, just skimming online. I mean, try to talk to as many dealers as possible if you're looking to buy metals. If you're looking to try to figure out how to find the right depository for yourself. I've done videos on how to select a depository, what to look for, what to ask for, what to maybe ask questions on, information that you may be able to receive from the depository, whether they have a balance sheet that's public, or what kind of insurance that they have, or how they're structured. Who owns the depository? Is the depository run by the their parent company, which is a gold dealership? So now you're worried about, you're storing your metal with a company that now is more transaction oriented rather than storage based. There's a lot of things to look for in these industries, or in this category of industry, that I think people just need to kind of wake up a little bit to. And that's why I don't mind people calling me for that kind of information as well. I'm more than happy to try to explain, the differences in depositories out there. Not everybody is the same that stores metal. Their structure's a lot different across the board. For example, we're the only depository I know of that's not owned by a gold dealer, a financial institution, or a cash in transit company. So we're not transaction oriented, meaning if the economy collapses tomorrow, we make our money on storage fees. That's not going to make us wealthy during the great times when everyone's buying metal, but it's not going to sink us when times get tough. And I think you're entering into an industry right now where now you're starting to see the tougher times. We've gone through three or four great years of profit margins. Well, that's ended. And so now you gotta, if you're gonna park your money with a depository, know that depository, know who's involved with that depository, as well as who owns it.
Now, you mentioned earlier, you would call up the depository and they had no idea who this guy was. If you're a customer of a company, maybe not Oxford Gold, but we'll say ABC Gold Corp, you signed up for one of these gold-backed IRAs. How could somebody actually verify that the metal is actually there other than just taking the guy's word for it? Is it the custodian you want to call? Is it the depository you want to call? I mean, how would you even
Typically, you start
verify
with your
this?
IRA custodian. The IRA custodian is sort of I kind of say they're like a trustee on your behalf for your account. They're your middleman between you and your money. It's just the way the IRA system is set up. People can't store their own metals in their garage in an IRA, so they're sort of the front line, per se. So they should have a record of what's received in. The problem you run into is if you're buying from a gold dealer that does not provide delivery, it's never going to be received in. So you could call the depository all you want. If they haven't received the metal, they're not going to be able to tell you why. So a lot of times, talking to the IRA custodian, they may have communications with the gold dealer because ultimately they send the money to the gold dealer that you're buying from. When you buy metals, there's a bi-direction form you fill out that will instruct the IRA custodian to send the monies to XYZ gold dealer. And so that's one way. So a lot of times those IRA custodians will try to reach out if the metal hasn't been received in a timely period, within 4 weeks or so. They may start making phone calls to try to get a hold of these dealers. But it turns out if it's a dealer that really is shady, they could probably call all they want. It's just going to go to a voicemail and they're never going to get a call returned. And then ultimately, what's going to have to happen is the client will probably end up calling, attorney general for that state or the Department of Finance for that state to try and start lodging complaints, actually getting them involved to try and maybe do an investigation as well. But that's typically how some of these unfold. Now, some dealers, legitimately just may be slow in making delivery, and they may be just aggravating to work with, but eventually the client does get their metal. But a lot of times, trying to lean on the IRA custodian because the IRA custodian, they may stop doing business with a gold dealer if the gold dealer isn't being responsive. So there maybe is some incentive for the gold dealer to maybe answer the IRA custodian's uh, uh, calls versus an individual customer.
So, I mean, it sounds like the best defense here is really researching that dealer that you're buying from to begin with. That's the easiest way to keep yourself out of trouble here, because once you send the money to the dealer, it's pretty tough at that point. If you sent it to one of these scammers, it's probably gone at that point.
Yeah, and the one advantage when you start calling around and talking to multiple dealers, just even if you just a bunch of online guys and you're just saying, "Hey, listen, what is the price that you charge for this? When will you provide delivery for the product?" You should be able to get all that information right up front. It shouldn't be this, "Oh, we got to wait for it to be made," or it's a special order product, or it's a very limited edition quantity. Because typically when they start saying limited edition, it may not even be made yet. It may be in production, for example. So while they're actually trying to pre-sell, like 10,000 ounces of silver, they may not actually make the product until they pre-sell the 10,000 ounces. So the way the industry works, it's just those are things that the client base or the consumer base should try to understand.
Every time I hear limited edition, I can't help but think, how liquid could the market really be for a limited edition item? Just avoid that stuff. Avoid the numismatics. I mean, look, folks, it's your money. I can't tell you what to do with it. I don't have that permission slip. But one of the things that always makes my spider sense tingle, if you will, is when people try to push numismatics or push that pre-33 stuff. They play the government confiscation angle with you. They're preying on your fears and your politics. And I just find it's better to avoid anybody who really leans too heavily into that. Because really, that's where the fees go up and that's where the commissions get bigger. But the
Yes.
investor usually doesn't do so well there.
And here's an interesting tidbit. A lot of people, you see this with these retail dealers that push pre-33 gold coins like the St. Gaudens and Liberties. They're $20 pieces. They're not actually 1 full ounce of gold. It's like 0.96 ounces, whatever it may be. But but the face value is $20. You buy a gold eagle bullion coin, at least the face value, and that's $50 for a full ounce of gold. And you don't have nearly as much premium. They say, well, because it's pre-33, it's going to be a collectible. So therefore, based on an old archaic executive order that's no longer actually in existence anymore, that because it's 15% value, it's greater than 15% value of the metallic content of the coin, that has a collector's value, it's going to be exempt from confiscation. But they don't tell you is, what we saw back in 1933 wasn't confiscation, it was actually nationalization, because they were given $20 for the gold, for the $20 gold piece back then, because we were on a gold standard. And the only way they could inflate the money supply was actually bring the gold back into the coffer, and then eventually revalue the gold at a higher price, obviously, because they had to expand the money supply. But that was the whole emphasis of it. It wasn't this grand scheme of taking your gold. I mean, it's interesting because if you look at the public, only about 10% of the public owns actual physical metal, bullion, that is. If you look at, and our depository, one of the things that makes our depository extremely unique in the world is we're the only depository I know of that's also an FFL, a federal firearms license dealer. And in Idaho, there's, everyone talks about confiscation of guns and things like that. There's only 2 ATF agents in the entire state of Idaho. I mean, you start to put these things together, and there's no way the government could do a whole, mark up a scale of trying to confiscate physical assets. It's just so much easier to go into a bank deposit account like Trudeau did and just shut off your transaction ability to move money around. That would have a much more damaging effect than taking somebody's physical asset. And that's where I try to explain to people this idea of confiscation and nationalization and concern is that you typically you're not going to see. It's just not something that's going to be a come to fruition. It would have to be a really meltdown scenario for the government to say, listen, we see the public completely losing their complete confidence in not only us but in the currency itself, that we got to put the brakes on this somehow. That's what ultimately it would maybe come down to. But that's still very far down the road.
Yeah, and if it does come down to that door-to-door confiscation, clearly that door that's right over your shoulder is the wrong door to go kicking in, because I just saw that guy walk by with an AR in his hand a couple of times while you were talking just now.
Yeah,
No reason we can't show that on the air, is there? I don't know if
oh,
we're
no,
like,
no. Yeah,
okay,
I think that's my new Radian AR 15 platform. So
one of these days I got to take a trip out there just to see the toys, Bob, just to see the toys. All right, last one I want to talk about. I got this question. Let me share my screen again. A man after my own heart. This guy on X asked this question in response to your tweet earlier today. Guy's name is U.S. Government Sucks a Lot. Like I said, a man after my own heart. He says, can someone make sense of today? Dollar and yields got nailed and silver fell even more. It was unusual, right? Yields heading lower today. Dixie heading lower today. Two things that are normally rocket fuel for silver prices, and yet silver dropped at the open this morning. What happened today, Bob?
yeah, I think primarily this was just profit taking. I think silver hitting $30 or getting close to that $30 mark, probably triggering short-term traders that bought it, at 27.50 in sort of that melt up run that we saw the last probably few days. It's just profit taking. Yeah, that's you have to remember the leveraged futures market uh, is it's much more price sensitive, especially on a technical level basis. So if you start to see a little bit of resistance building and the market starting to kind of stop at a certain price, you're going to get some profit taking coming in, especially after a dollar and a half, $2 move in a price of an asset. That's very typical. So I wouldn't look at the price action today as the end all for silver.
Yeah, and the only thing I could say to somebody who's watching the price of silver at the market open at the beginning of the day is don't. If you're excited to see silver up pre-market one morning and gold, the dollar's down and yields are down, it's going to be a great day. Silver's up pre-market. Turn your machine off and step away from the computer because you're not going to like what you see at market open. I've seen it too many times. Big drop right at the open. So saw more of that today.
Yeah, I would think if gold doesn't break down through 2,500 on the downside, I think silver starts to firm up here. I think all it's doing is just making an attempt to start building pressure to break through 30. And I think it's odd because the way the public is reacting to the markets and being sort of they're not really jumping on it. They don't have any sense of urgency to buy. I think it's the market will probably force them in at higher prices.
And that's a good thing, right? When you don't see that peak retail fever, that means there's still more upside that is not yet into the market. And that is the buying enthusiasm that could propel prices higher. It's when you have that peak enthusiasm that it's time to start thinking about taking your profits because who's left to buy at that point, right?
Yeah, and you have to remember, people say, well, what's going to move the price of silver higher? Seasonally, this is a very strong period of time for the metals. You have India has what they call their holiday season or festival season, Diwali, which typically you start to see the buying start to ferment in August, going typically into October, which is when the holiday starts. I think it was a month late in last year, but that they're physical buyers. They buy physical gold, silver, and they make it out of jewelry and so forth. And and their culture is just much more attentive to the physical object itself. But what people may not have realized, and I kind of posted this, I think probably about 3 weeks ago, India dropped their tariffs on gold, silver, and platinum from about 15% down to 5% tariffs. You just had a 10% drop in the price of metal in India. And don't tell me that's not going to spur demand. I mean, I think you're going to see, I think, some outside moves, maybe not as much in gold because they tend to be very price sensitive buyers, but if silver is sort of not at all time highs, you may see more silver activity coming out of India this year.
So we had that tariff drop. We talked about that on my morning live stream a couple of weeks ago. I remember that story. Maybe some of that buying enthusiasm might be weary of gold at $2,500, but they might look and say, hey, silver sitting here below 29 or right around $29, $30, nowhere near an all-time high. Maybe I'll take some of that capital there, or maybe even a platinum or a palladium, one of the other semi-precious metals, if you will, or the PGM group could be the beneficiary there. And speaking of India, since we went to the Eastern Hemisphere, let's stay over there for one quick second. The China buying, is that still a thing, or is that kind of tapered off from the earlier part of the year?
Yeah, I think some of the export data shows that metal moving to China has slowed down, and I think that's probably reminiscent of basically the high price of gold at this point, where maybe that slowed the market down a little bit. That's why silver could be interesting from a jewelry perspective. That if people want still jewelry per se, they may just go with a cheaper metal at this point, or even plate or platinum. To be honest with you, that platinum could see a resurgence, especially against gold. I mean, you're talking two and a half. Gold's 2.5 times the price of platinum now. I mean, platinum that's about as cheap as I think I've ever seen the platinum to gold ratio. So you may start to see the white metals begin to maybe kick in gear here from a jewelry demand point of view.
And I know platinum took a little bit of a hit, I think, from the EV fever that had been sweeping in the West, and everybody's saying there's not going to be any catalytic converters made anymore. Yeah. And so if everybody's driving an EV, then we don't need as much platinum. Maybe a little bit of overreaction to that because we've seen the EV market pull back with its enthusiasm. pretty
Yeah, and
substantially in recent
yeah,
months.
yeah, and I reported this back in March when you had the U.S. government, I think it was Department of Transportation, put out their basically revised sort of uh, they backed away from EVs and electric vehicles, and they started to implement a new plan of recommending hybrids back into the market. So that hybrid activity, like you just said, the internal combustion engine isn't going to be gone. It's not going to go the way of the dodo bird by 2030. But also this idea of potentially, the hydrogen fuel cell starting to take maybe a little bit more market share, maybe not yet from consumer automobiles, but it's certainly going into some of the big industrial transportation methods, shipping, buses, uh, uh, large trucking fleets, things like that. So it's a slow moving train. Or slow moving ship, I guess, oil tanker, whatever you want to call it. It just takes time to build. But I think platinum is an interesting story just from a relative pricing standpoint. Because like 20 years ago, platinum was twice the price of gold.
Yeah. And a lot of geopolitical risk associated with platinum, right? Almost all of it comes from South Africa and a little bit more from Russia. But, you're talking two BRICS countries. I don't really get down with the whole BRICS thing as much as the next guy does. I think that's a little overhyped. But, BRICS does control the global supply of PGM metals. And that's a potential upside catalyst there to platinum prices.
Yeah.
Well, Bob, I want to thank you so much for your time. I know we ran a little bit long today and we were talking for like 45 minutes before I even hit the record button here. So sorry, I took up more time on your calendar than I signed up for. But once again, folks, that's Bob Coleman. He's the CEO of Idaho Armored Vaults. Now, you are a depository, a dealer. I mean, you do pretty much, you're a one-stop shop for metals, right? You have everything in-house there.
Yeah, basically, the depository is one of the largest private depositories in the country. We store about 700 million in assets, and then my registered investment advisory firm, I manage a hedge fund that's in physical metals, and then also as a subsidiary of that investment advisory firm, I also buy and sell metals for clients, and then we buy through wholesalers and refiners. That's how we actually are able to get some very, very low pricing for our clients. And our pricing is right on our website as well, on the goldsilvervault.com site. So people can check that out. And sometimes we can get even better deals if it's backdated product or product that's being sold back to us. So, our goal is definitely to try to take care of the customer first. We're unlike the typical dealer that holds a lot of inventory. We just basically, when the client needs it, that's when we go out and buy it, and we're able to keep prices and our costs down, so that really passes through to the customer.
Excellent. And of course, if you like Bob's commentary and you want more of that, you can follow Bob on X or Twitter. He is at Profits Plus ID on X. This is his page right here. By the way, guys, I'm going to put links to both Idaho Armored Vaults and Bob's Twitter down in the description below. So I highly recommend those. Bob, and again, I think you have it pinned here. Yep, your February 16th call. This was really fantastic call that you had on February 16th, saying we could be in for the mother of all short covering rallies for silver. And man, you nailed that. I think it was like 3 days later that monster run in silver started after you made that post. So that was just a really good call. And well, I can see why you've got it pinned there. That was a pretty good one. So highly recommend Bob's X. Once again, Bob, thank you so much for taking the time to talk to us. And everybody else, until next time, live small and dream big.
Thank you.